What if being perfectly rational makes you a worse investor? The deepest paradox in finance is that rationality itself can be irrational. That markets depend on human irrationality, and the most successful investors are not the most rational, but the ones who understand and exploit others' biases. Consider the Concorde Fallacy, named after the supersonic jet that governments kept funding long after it was economically hopeless. You've invested years and billions into a project. Continuing means more losses, but stopping means admitting failure. The rational choice is to ignore sunk costs and cut losses. Yet most people continue, because the pain of admitting failure outweighs the pain of further losses. This is not a minor quirk, it's a systematic error that distorts corporate decisions, government projects, and personal investments. Standard finance models assume investors maximize expected utility. The formula says you choose the action that gives the highest expected satisfaction, where satisfaction is a function of wealth. The rational investor calculates probabilities and outcomes, then picks the best. But this framework ignores the emotional cost of admitting a mistake. In the Concorde Fallacy, the utility of avoiding regret can outweigh the utility of financial gain, making the irrational choice feel rational to the decision maker. Imagine a trader who updates beliefs perfectly with Bayes' rule, feels no fear or greed, and always acts to maximize expected value. In a panic, this trader buys because prices are below fair value. In a bubble, this trader sells because prices are above fair value. But if everyone were like this, there would be no panics or bubbles. The market would always be efficient, and there would be no mispricings to exploit. Therefore, the existence of trading profits implies that most market participants are not fully rational. Bayes' rule is the gold standard for rational belief updating. It tells you how to revise your probability estimate when new evidence arrives. The formula says the posterior probability is proportional to the likelihood times the prior. A perfectly rational trader would use this rule perfectly. But in practice, people anchor on old information, overreact to news, and underreact to slow trends. These deviations create the very mispricings that rational traders can exploit. Financial markets need irrationality to function. Without emotional traders, there would be no liquidity, no volatility, and no arbitrage opportunities. The rational trader's profit is the irrational trader's loss. This is not a flaw, it's the engine of the market. Even the most sophisticated quantitative funds rely on the predictable mistakes of others. They model fear, greed, and hurting because those forces move prices. So the market is a machine that converts irrationality into profits for the few who understand it. In an efficient market, the no-arbitrage condition holds, the price equals the expected discounted payoff. If this holds for all assets, there is no free lunch. But if some traders are irrational, prices deviate, and the condition is violated. The rational trader then steps in, buying undervalued assets and selling overvalued ones, pushing prices back. This is the mechanism that makes markets efficient in the long run, but it only works because irrational traders exist to create the deviations. The rational investor aims for perfect information processing and emotional neutrality. The successful investor, in practice, understands human psychology and market sentiment. The rational investor might buy in a panic because it's logically correct, but the successful investor also considers that the panic might deepen. The successful investor knows when to follow the crowd and when to break away. This balance between logic and psychology is the real skill. The best investors are not just good at spotting others' mistakes, they are also aware of their own. They know they are susceptible to overconfidence, anchoring, and loss aversion. They build systems to check their biases, like pre-commitment rules and diverse teams. This metacognition, thinking about your own thinking, is rare. It's what separates professionals from amateurs. The rational ideal is unattainable, but self-awareness is achievable and profitable. So, the deepest paradox is resolved: rationality is an ideal, not a reality. The market is a complex system of imperfect humans. The investor who tries to be perfectly rational will fail because they ignore the human element. The investor who embraces the irrationality of others, and their own, can succeed. The key is not to be rational, but to be adaptive. Understand the rules of the game, which are written by human psychology, not by mathematical elegance. let's summarize the core insights. First, the Concorde Fallacy shows that sunk costs distort decisions. Second, pure rationality is unsustainable because markets need irrationality. Third, the best investors exploit others' biases while managing their own. Fourth, self-awareness is more valuable than mathematical perfection. Finally, the market is a psychological system, not a rational one. In conclusion, the rationality paradox is not just a theoretical curiosity, it has practical implications for every investor. By understanding that markets are driven by human emotion, you can position yourself to profit from the mistakes of others. Remember, the goal is not to be perfectly rational, but to be strategically rational, aware of your own biases and those of the market. We dive deep into market mechanics and behavioral finance every week. Stay rational, but not too rational. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.